Hello, and welcome to EPK Capital's daily market briefing for Friday, October 17, 2025. In the next few minutes, we will dissect the key market movements and macroeconomic events of the last 24 hours. So grab your coffee, and let's get right into it. Yesterday, on October 16, a wave of concern washed over global markets, originating from the U.S. banking sector. This sent ripples across the globe, impacting equities in Europe and Asia. Let's start with a look at the major indices. In the United States, all three major indices closed in the red. The Dow Jones Industrial Average fell by approximately 0.7%. The S&P 500 shed about 0.6% of its value, and the tech-heavy Nasdaq Composite saw a decline of around 0.5%. This bearish sentiment was mirrored in Europe. The Stoxx 600, a broad measure of the European market, remained relatively flat. However, major country-specific indices felt the pressure. In London, the FTSE 100 was down. Frankfurt's DAX and Paris's CAC 40 also ended the day lower. Asian markets, which traded earlier in the day, had already set a negative tone. Japan's Nikkei 225 dropped by about 1.4%, Hong Kong's Hang Seng saw a significant fall of around 2.5%, and the Shanghai Composite in China was also down by approximately 2%. So, what were the catalysts behind this global market dip? Let's delve into the macroeconomic events that shaped the trading day. The primary driver of yesterday's negative sentiment was a renewed fear in the U.S. regional banking sector. Reports from Zions Bancorp and Western Alliance Bancorp regarding bad loans and allegations of fraud triggered a sell-off in their shares and raised concerns about broader credit stress within the American economy. This news brought back memories of past banking instabilities and prompted investors to reduce their risk exposure. Adding to the unease was fresh economic data out of the United States. The Philadelphia Fed Manufacturing Index for October came in at a dismal 12.8. To put that into perspective, a reading above zero indicates expansion, while a negative reading signals contraction. This was a significant miss from expectations and pointed to a slowdown in manufacturing activity in the region. The NAHB Wells Fargo Housing Market Index was also released, providing a snapshot of the health of the U.S. housing market. Compounding the data-driven concerns is the ongoing U.S. government shutdown, which is now well into its third week. The shutdown has led to a delay in the release of several key economic reports, leaving investors and policymakers with a less clear picture of the economic landscape. Across the Atlantic, the U.S. Office for National Statistics released a raft of data for the month of August. This included the monthly GDP estimate, which is a key indicator of the country's economic health, alongside data on the services and production sectors, as well as the UK's trade balance. These figures are being closely watched for signs of how the British economy is navigating the current global headwinds. Further contributing to the cautious global outlook were comments from the International Monetary Fund. In its latest World Economic Outlook, the IMF painted a picture of dimming global growth prospects, citing the rise of protectionist policies and increased market volatility as significant threats. A more hawkish tone came from a member of the Bank of England's Monetary Policy Committee, Catherine Mann. She warned that UK inflation might prove to be stickier than anticipated and could remain above the central bank's 2% target for an extended period. This suggests that the Bank of England may need to maintain its tight monetary policy for longer, which could have implications for economic growth. Now, let's turn our attention to the political arena, where comments from major global figures also played a role in shaping market sentiment. U.S.-China trade relations were once again in the spotlight. President Donald Trump made remarks that reaffirmed the existence of a sustained trade war with China. He also reiterated threats of imposing 100% tariffs on Chinese goods. These comments added another layer of uncertainty to an already nervous market, as investors weighed the potential impact of an escalating trade conflict on global supply chains and corporate profitability. Meanwhile, in Europe, there was a notable development in French politics. Prime Minister Sébastien Lecornu's government decided to suspend its controversial pension reforms. This move had a positive impact on French markets earlier in the week, but the broader negative sentiment driven by the U.S. banking fears ultimately overshadowed this domestic development on Thursday. Looking at the longer-term policy direction in Europe, EU leaders were reportedly discussing the critical balance between pursuing their ambitious green transition and maintaining the competitiveness of European industries. This is a crucial ongoing debate that will have far-reaching consequences for the European economic landscape in the years to come. Finally, let's dive into the world of digital assets and take a look at the major crypto news from the last 24 hours. It was an eventful day in the crypto space, with a mix of technical glitches, strategic investments, and bold price predictions. One of the most talked about stories was the incident involving Paxos, the issuer of the PayPal USD stablecoin, or PYUSD. In what was described as an internal technical error, Paxos accidentally minted a staggering 300 trillion PYUSD tokens. The company quickly identified the mistake and burned the excess tokens. While the error was rectified, it sparked a conversation within the crypto community about the robustness and security of the infrastructure underpinning stablecoins. In more positive news for the industry, Coinbase Ventures, the investment arm of the publicly traded cryptocurrency exchange, announced a strategic investment in the Indian crypto exchange coin DCX. This move is being seen as a significant vote of confidence in the potential of the South Asian crypto market, despite the regulatory uncertainties that have historically existed in the region. Looking at price action, some prominent crypto analysts, including Tom Lee and Arthur Hayes, reiterated their bullish stance on Ethereum. They both maintained their prediction that the price of Ether could surge to $10,000 before the end of 2025. This highlights the continued optimism among some market participants about the future of the Ethereum network and its native token. On the other hand, it was a tough day for Dogecoin holders. The popular meme coin experienced a sharp price drop. However, some on-chain data analysts suggested that despite the short-term price volatility, the long-term fundamentals of Dogecoin remain strong, with evidence of accumulation by long-term holders. Finally, in a sign of continued institutional interest in the digital asset space, Andreessen Horowitz's crypto-focused fund, A16Z Crypto, made a significant investment in the Solana ecosystem. The venture capital giant invested $50 million in JITA, a key protocol on the Solana blockchain. This investment underscores the growing competition and innovation within the Layer 1 blockchain space. In summary, yesterday was a day of risk-off sentiment in the traditional markets, driven by concerns emanating from the U.S. regional banking sector. This was compounded by some disappointing economic data and ongoing political uncertainties. In the crypto world, despite some price volatility, there were also signs of continued growth and investment, highlighting the dynamic and ever-evolving nature of the digital asset industry. That's all for today's market update. Be sure to subscribe and join us again tomorrow morning as we continue to track the events shaping our financial world. Thank you for watching.